Hey everyone, how you doing today? This is Mr. Vegeta channel bringing you a little bit of a different twist here because I usually bring news about coins and discounts and coupons and stuff like that. But I figured I'll do a summary of this because I know some of you are gold stackers, silver stackers, and obviously Robert here, Robert Kiyosaki, does save some of his money in gold and silver. And for those of you who are new to this channel, welcome, and let's get started here. So the first thing he came out right away saying was that the rich is going to get richer because taxes and debt will be in their favor, and the poor will become poorer and the middle class will shrink. This is nothing new, but it's something that he stresses and he reiterates because that's just the trend that always has been. And I think the Republicans coming into office for this year, they'll probably do more in favor of businesses, real estate owners, and stuff like that. But as far as the poor becoming poorer, there is data to back it up. And here is a little chart here of the food stamps usage from 1969 all the way to 2013, and I'm sure the 14 here should be a little higher. It's called SNAP is called Supplemental Nutrition Assistance Program, which is another fancy word for food stamps, and the source from this is Department of Agriculture. So right around the time we had our crash of 2008, 2009, right after there, then you see the amount of people going on food stamps from 30 million to maybe 34, then 40 million, 45, 47, 48, maybe it reached 50, or maybe kind of curved back around here, who knows. But we don't have the data for the 2014 yet, but you can see the obvious increase here of people going on food stamps, which means a lot of people have become poorer. And just to show you the amount of spending for food stamps, it will tell you here that it's gone way up, especially from around here, from here, 2007, it has almost doubled, right? 110, yeah, it doubled from 2007 to 2013, which is an estimate here, but we're already into 2014, so the money is going to the poor to feed them. If they don't feed them, then we're going to have problems. So that is why the government is paying for food stamps. So to reiterate, taxes will go up for the middle class and lower for the rich who own businesses and real estate. Congress will pass laws that favor the rich and raise taxes on the middle class. Employees will pay more in taxes. And here is a little chart that shows you who paid their fair share of taxes. Estimated federal income taxes paid in 2009, and you see here, this middle class, this middle 20%, bottom 40%. So they're not paying as much, but still, look at the top 1%. It's lower than the middle and the bottom. Look at the top 5%. It's lower, right? So share of total federal income taxes paid, over here is 22%, 17%, but look at the middle here. Look at the middle, the amount of taxes that are right in the middle, or I guess we can call it a bell curve. A bell curve is like this, and the middle is the one always paying the most. Okay, and we're already taxed enough, but when Obamacare came in 2014, so we haven't really seen the effects of it yet, but as we keep going into the future, it says here to pay for generous subsidies to purchase health insurance, a huge expansion of Medicaid and other new spending, Obamacare raises taxes and adds 17 new taxes or penalties that will affect all Americans. So there's got all kinds of taxes here, which I'm not even aware of or familiar with, but it just gives you the scope of what's going to happen with taxes here. And the next thing that he came up with was consumers will see inflation, which more or less I think we've already felt it. With the gas price coming down a little bit, we're seeing some relief at the moment. But the purchasing power of your dollar in terms of like buying regular goods and stuff has gone up since, you know, uh, I don't know, back in the 90s, I think pizza was like a buck 50, and I like to use pizza as a source of inflation because I remember pizza was like 50 cents in the 80s. So right now it's around 250, maybe 225, depending on where you live. But let's see if pizza goes to $3 a slice. All right. So the next point was interest rates will remain low for 2015. There's a lot of speculation that this time around the Fed is going to raise interest rates. And special shout out to Phi. He gave me this chart here maybe like a month ago. He's like, look at this chart and it tells you the actual rate here in black line, which is pretty much consistently low. And these blue lines and red lines and green lines have been forecast for interest rates to go higher, and they've been wrong almost every time, right? So here we're in 2015. Where do we go from here? If the black line does go up, then things might change and everything. But for the time being, interest rate will remain low, according to Robert. So the next point was national debt will rise. Uh, just look at the debt clock. We all know. Just go to U.S. Debt clock and then on a website and you'll see it. And actually, we're going to go see it in a little bit. And then we have student loans hitting $1 trillion or even more now. So let's take a look at the debt clock as we speak. Today is February 11th, and it is almost 18.2, well, right now $18.1 trillion in U.S. national debt. At the rate we're going here, perhaps we'll reach 19 trillion before the end of the year, right? And here is a chart of student loan debt compared to some of the other loans in the market, credit card debt and auto debt. Let's see, this red line is the student loan debt just increasing all the way to 1 trillion. Credit card debt is in this yellow green line, uh, and it actually has come down closer into 2012. I guess people stopped spending after the crash, so people got a little bit wiser here. And then you have auto loans, which has been kind of up and down, and obviously after the crash, things started to slow down a little bit, but then it started picking up, and maybe if we were able to add another 2-3 years, we'll see this going up a little. Who knows? Okay. And one of the things to really pay attention to is demographics. And one of the things that they said was about demographics of people who are married versus people who are single, and there are more single people than there are married people now. So rental properties are in demand because of that. If you're not a family, why do you need a big house, right? So you need an apartment or housing for single people to live in, and that's high in demand. And the other demographic fact that he mentioned was well, actually he didn't mention this. It was actually another guy that mentioned it. But baby boomers, from the next 18 years, since 2011, baby boomers will be turning 65 at the rate of about 8,000 people a day. So that's going to put a lot of stress on Social Security, Medicare, things that older people are going to need to retire or just make it, through their day. Because if they don't have a job and they don't have a retirement like we are supposed to have with pensions and stuff, we don't have that. Most of us don't have that anymore. So we can take a look at this chart here. Social Security and Medicare's hospital insurance trust funds face cash deficits. So Social Security cash flow in yellow, and then Medicare hospital insurance cash flow in blue. So up over here, up to 2015 will be for Social Security, it'd be okay. Maybe 2016, just borderline here. And the blue here in Medicare health insurance trust funds have already gone below zero. So how are they going to cover for this come around 2016? Okay, this is going to put a lot of stress on this system here when so many people are going to be turning 65 and getting older, and they're going to need handouts. They're going to need benefits. So with that said, Robert's juiciest prediction is that we're going to have the biggest crash in 2016. And he is very concerned that people who invest and hold their money in 401ks and IRAs and stocks and mutual funds, and you know, those are the people he feels that they're going to get slaughtered. Okay, and I looked up some information on how much money is actually in a 401k and an IRA, and I found one source here saying that investors collectively held $4.8 trillion in an IRA account 2011. So that's what, 4 years ago, and we should see this being higher now. And 3.8 in the private sector. Defined contribution plans like 401k is 3.88 trillion. So that's a lot of money, almost $9 trillion, and possibly maybe 10 or 11 by now. And this is according to US News. So let's take a look at a Dow Jones chart here from 1980, and obviously this is going to be a steep incline, so I can't fit everything in here. This goes from 1980 to 1999. 1980, the Dow Jones was around 750, and you see a little crash here. And then we had a little bull run, and it went up to 1981 and a half, and then another crash, or not a, maybe a correction here. And then from 82 and a half, we go to 84. The Dow picks up a nice gain here, another correction, and then big increase from 84, 85 to 87, which I remember here. There was a big crash in the Dow Jones and the markets. And back then, I knew nothing about stock markets or anything, and I was taking an economics class in high school back then, and the teacher was like, "Hey folks, do you know what happened today? The stock market crashed." And everybody's like, "What? What's a stock market?" And I was like, what is it, a building? And we have no idea what that was, and nobody really cared. You know, the young people didn't care back then, but it was a big significant moment where the stock market almost didn't, survive. But it survived, and it started to go higher and higher and higher until over here, I remember we had like a recession. Things were getting a little difficult, and I think George Bush Sr. said they had to raise taxes, even though he said no new taxes, right? And then we started to come up, bubbling up, and then the internet and the computers are starting to rise, and I think over here is around 1995. Right here is 1995 when boom, we had a major dot-com bubble here, all the way up to 11,000 or so. And we had some corrections here and there. So that's the 20-year chart, okay? And now we have the following 20 years, and the top, we saw the dot-com over here, that was the top, and then we started to have some sell-off, 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 and then I think around here it was the 9/11, and then we see a major crash here. We try to make a rally again, but then I think in 2003, here, right around here, we started the war. The United States started bombing Afghanistan around this time here. So from here on, war tends to create some kind of economic prosperity or boom, and we started to see another trend going up, up to around 10,000 here, 11,000. We kind of stayed steady for a little while here, but then we started to see another bubble, and this bubble here was the subprime and credit default swaps and things like that, derivatives, all kinds of things that made this go up so high. And then we had the biggest stock market crash from 14,000 to 6750 or something around there, right? So that's pretty bad. And that was one of the scariest. Uh, Sorry, the video got cut off there because I ran out of time, 15-minute limit there. But getting back to this chart here, it was quite a scary moment of, you know, trillions of dollars just getting wiped out in a very short amount of time. And, the scariest time we had before that was 9/11, where a lot of people died, and, we had war on our minds, and, you know, uh, security issues, threats, raising the DEFCON level. There are all kinds of things that we had to psychologically endure during this time. And now we have a whole new wave of, uh, shall we say, boom, but not exactly the boom that we've seen back here, where most of this was about, economic production, people were getting jobs again, so on and so forth. But here, a lot of people were saying, I don't have a job, I don't have a job, but yet the market was going up and up and up and up. And then, we were trying to figure out why this was happening. And the whole rise in the markets had a lot to do with the Federal Reserve doing their QE program. There's QE1, QE2, QE3, and I don't know how many we had. Maybe we had 3 or 4. So we're currently, I mean, this chart doesn't even have 15, the whole year 2014 here, but over here the top is at 16,750, and we've already surpassed that, and we have gone beyond this chart into the 18,000s. So today, as we speak, I think the Dow is in the high 17s. And where do we go from here? Do you continue to keep your money in the markets and suspect that it'll go higher and higher and higher? Or do we start becoming cautious now and take money off the table? So the whole point with these charts is that you don't want to get fleeced here like this. A lot of people lost their money, their homes, their jobs, even their retirement accounts, got slashed in half or more. We do not want to see that happen again as we see the markets going higher and higher. And there are people who think the markets will go to 22,000, 26,000, higher and higher, where others will say, no, we're going to have the biggest crash of them all. So, I can't tell you for sure exactly what's going to happen. Robert thinks he does. He thinks the crash is coming ahead. And all right, so enough with the charts. He has some other information regarding wealth, and this is from Chris Martenson. He read his book and came up with 3 terms of wealth, which are primary, secondary, and tertiary. Primary wealth is resources like oil, gold, fish, cattle, wheat, things that we just need and use. Gold we technically don't need, but it's been used as money back in the days. So I'm going to read page 199 of Robert's book here. And this goes on with like a Q&A type of discussion in the book here. So can anyone participate in primary and secondary wealth even if they have very little money or financial education? And he says, sure, anyone can. For example, anyone in the world can invest in real silver, which is primary wealth. As I write this book, silver is selling for approximately $20 an ounce, down from a high of almost $40 an ounce. If someone cannot afford $20, they can still find pre-1964 US dimes made of silver. In other words, for 10 cents, anyone in the world can become an investor in primary wealth, silver. So why is this a good investment? Prices of gold and silver will always go up and down due to market demand and government manipulation. But as long as governments are printing money, saving silver and gold, primary wealth makes much more sense to me than the tertiary wealth strategy of saving dollars. So I didn't explain about tertiary wealth or secondary wealth. Secondary wealth is basically production of the the things in the primary wealth, like oil, drilling, farmers harvesting food, crops, and fishers and miners of gold and silver and so forth, and also any business that tries to innovate and provide goods and services to people. That's what you call secondary wealth. And tertiary wealth is basically paper instruments that are representations of the secondary wealth, like stocks and mutual funds that we see in the stock market. So Robert goes on to say, as long as the governments are printing money, saving money is the riskiest thing you can do. Silver has one advantage over gold and paper money. The supply of silver is declining, supplies of gold remain relatively constant, and the mountains of paper money are increasing. Paper money can now be created in microseconds. It takes years and millions of dollars to find, develop, and bring new gold and silver mines into production. Stockpiles of silver are declining because silver is an industrial metal as well as a precious metal. Silver is used in medicine, water purification, electronics, and has hundreds of other applications. Don't forget that silver and gold have been real money for thousands of years. It's hard to say with certainty how long the US dollar will be around. So that was Robert's take on gold and silver, and I'm sure many of you have differing opinions about this. And, as for his claim that silver is running out because it's an industrial metal, well, that's also arguable too, right? Because some of those electronics that are used, they use the silver and the gold, and eventually these machines get thrown out, tossed out, but it could be recycled. So once it's recycled, perhaps they can take the gold out again and the silver out of the circuit boards and stuff like that. So a lot of differing opinions, I'm sure, will come out of this. So we'll leave it at that and come to the four ages that Robert talks about, which is the hunter-gatherer age, agrarian age, industrial age, and the information age. So there's four classifications where once we were hunters, hunting for food, and then we were able to figure out how to grow crops as farmers, and then we moved over to the industrial age where machines started to take over, and now we are having computers and the internet, and that's taking over our lives. So we need to adapt to how the economy is going to grow here on forward. And the interesting part that Robert says in the information age is that a lot of things are invisible, that you really can't see the changes coming ahead. So what does Robert mean by invisible? What does he mean by that? So he says back when the cars were around, when it started to show up, people were able to see that it was a car coming and developing, but a lot of people at the time didn't believe the cars would replace the carriage and the horses, right? So now in the information age, people can't see that car coming. They can't, it's all invisible because a lot of the things in the information age is simply information and not things, right? So he says that now in the information age, most people won't see the changes coming ahead because the asset of the information age, this is really important, the asset of the information age, I'm going to highlight this here, is in patents, trademarks, and contracts. Things like that will be an asset to you because those are going to help you create cash flow. Okay, and things are shifting more towards a cyber economy. So if you know how to sell online, making a website and stuff like that, that's going to help you in the long run, right? And where you can manage and run a business with your smartphone. Yeah, these days you can run a business with your smartphone. Smartphone's like a computer. So this is what he means by invisible in the information age. And we're almost coming to an end here. I just wanted to mention about Grunge here. Grunge is a book written by Buckminster Fuller, and he says the current monetary system is run by Grunge, and Grunge is an acronym for Grand Universal Cash Heist, which is a team of people that control our money, our government, and our banking system. So will the markets crash as Robert Kiyosaki predicts? And obviously, Buckminster Fuller also forecasted a big crash coming ahead, because this system here is more or less corrupt and is stealing the wealth of actual people, regular people going to work, making a living, trying to earn their money, and they feel that it's not going to work forever. So if grunge can no longer manipulate the markets and the free markets take over, then the market will go wherever it wants to go. And Robert thinks it will go down. What do you guys think? So in closing, I'll just share my opinion about what's going to happen in the next few years. Just with the data, looking at the data for Social Security and Medicare and the demographics of the people getting older and putting a lot of stress on the benefits or the entitlements, I think there's going to be more difficulty ahead. Whether it turns into a super crash like Robert says, that I don't know, because the government can always print money and stuff like that. But if it does crash, or if we have a significant correction, I hope people don't lose money like we did last time. But a lot of people did. So I thought this quote that I found on one of my emails was quite fitting. So I'll read this to you and close here. The real measure of your wealth is how much you'd be worth if you lost all your money. Unknown. So I'd like to thank you all for watching. It's a long video. I don't usually do long videos like this. If you have any comments, if you like the video, please press like. If you haven't subscribed already, please subscribe. And I will speak to you guys later.